Hello, here I am again with Alan. Hi, Alan.
Hi, Nikki. Great to be
Alan,
back.
yeah, Alan's with the Canas Realty. They specialize in helping amazing buyers on the peninsula of Northern California buy homes.
We try a lot.
You do, you're awesome.
So, Nikki, I know the conforming loan limits have changed. How does this affect a buyer with a lower down payment be able to purchase?
Yeah, that's a great question. They have indeed. They have gone up quite a lot. So there's two different numbers. There's a national number, which is 726,200. What this means, conforming loan limits, are the loans that are sold to Fannie Mae and Freddie Mac. They conform to Fannie and Freddie's rules. Fannie and Freddie are agencies that buy mortgages, and they just have more flexible underwriting rules. So that's why we like the conforming loans, because they're a little bit more flexible in how they underwrite. The other loans you hear of is non-conforming or jumbo. It just means they're bigger than these limits that I'm talking about. So nationally, it's 726,200, but here in the Bay Area, in most counties, it's actually gone up to 1,089,300, which is a lot. I mean, that's a high loan amount that now enables us to actually buy a house with the conforming loan limits. And what you asked just then about the low down payment is so key. That is, we can combine a first loan and a second loan, still use the conforming loan rules, which is more flexible, and put just 10% down. So we combine it with an 80% first loan of $1,088,000, a second loan of 136, and we're buying $1,360,000 house with just 136,000. I know, it's crazy, isn't it? So I mean, it is not still a small chunk of change, but the other beautiful thing about conforming loans is they don't have high reserve requirements. So it's not like you also have to have another 100,000 sitting in the bank after you've closed escrow. So there's lots of good reasons why this is helping homeowners get into housing with more flexible rules. So 80-10-10 is just a term for putting a first loan of 80%, a second loan of 10%, and then the buyer puts down 10%.
How does this work with mortgage insurance? Do you
Yeah.
still have mortgage insurance?
Yeah, great question. No, the reason we do the 80-10-10 is one of the reasons, other than to take advantage of the conforming loan limit, is to avoid mortgage insurance. So mortgage insurance is required whenever you put less than 20% down. But in this particular loan, because you've got a first loan of 80%, their rules are it's an 80% loan. So the fact that there's a second does not require mortgage insurance. So it's another great way of being able to avoid that payment that goes towards basically an insurance policy that covers the lender. So it's a good plan.
It's a great perk in the Bay, especially for the Bay Area.
Yeah. So $1,360,000. If anybody's watching this nationally, sounds like you should be buying a castle, and I agree with you. But in the Bay Area, it doesn't get you the castle. It's going to get you on the map, which is really huge. And then you work to pay off the second loan over time, or refinance in the future and roll the two together, which often happens.
Perfect information. Thank you, Nikki.
You're welcome. Great to see you.
You too.